Hello, guys. Sorry about that. Is everybody there? Old man hitting the wrong button. That was a problem. Have we got anybody? Sorry if I missed you at the start. Yeah, hi, guys. So I presume you didn't get any of what I was talking about there because I was talking to myself. Afternoon, Bletchley Trades, star 198. Good morning. So is there anything you want to talk about? I was going through the start of last week, just saying how it's all rolled over, blah, blah, blah. Powell the Towel, as we called him, has finally pivoted yet again, double pivot. Doesn't look like we are... it doesn't look like we're getting any rate cuts before the elections at the moment, unless the data changes, but it's probably not the issue. This week, particularly, it's all about earnings and the Mag 7. So it looked like we had a lot of capitulation in the tech side of things. We'll have a look at a few charts on that. Actually, do you know how to work out percentage risk using win rate and risk reward? Well, I'll do that separately. If you want to come and speak to me on an actual, I'm speaking to someone today doing this kind of thing. You need to come in to me and request a risk meeting. Send in an email, and then I'll get you a one-on-one. So yeah, what we had happening overnight, then not a great deal. Gold, which is the chart we've got up at the moment, isn't it? Where's that gone? Yeah, so we were talking about post that high at the top of the channel, and we had a 3-wave down to put in that 4 in the order block around 23.20 support that a lot of people have been looking for. Since then, we've been putting in a series of 3 waves and then a pullback of what has developed into a further 3-wave, seemingly in a triangle, but I'm not totally in love with that. I've moved the up channel today to reflect the lows of the 2, the high of the 3, and if the current price is 4, just to allow for that being the new trading range. Again, it does look like we're going to have to come and play with this support, doesn't it? And I wouldn't be surprised if we put in an equal legs from that top on the trading channel to put in a new low for the move. So that might bring back in this round number figure, 2,300. But net, I think we're still in the uptrend. And we'll have a chat later on about yet another way of looking at why gold is so cheap. Diamond, hello. Yes, hello, Diamond. Just throw in any questions if you've got them. So yeah, gold, vicious moves. I know a lot of people have tried to buy it on that support today and in the 40s, and it looks like it's thrown the bathwater out. It's due a pullback, isn't it? All the geopolitics that's thrown at it, and things don't always move in the straight line. But it is either this diamond pattern or it's an equal legs. I'm pretty sure. I don't think we're into the higher cycle wave 4s yet, so we can still move up into this 2,500 range, just being in that trend channel without getting over exciting. Got data coming up this week. It's generally PMIs. We've got durable goods and PCE at the end of the week. PCE, the Fed's favorite. You never know. We might get a surprise from that. It should be the lowest of the inflation measures. Brandon Southgate. Will ACG release stats like how much money is being made, how much traders are passing challenges? I don't know. That's a question really for George and Alex, really. Is that something that you see if you're with other firms? I mean, there might be a delay on my questions coming through. If you could answer that, that'd be useful, and I'll pass it on to Alex. Do you only get pass rate stats? Okay. I mean, what are they pass rate stats like at other places? How do you know if the market? So, Deshaun, welcome. How do you know if the market is going to reverse or continue? Well, it depends on the indicators you're using, and you can often shows itself up in momentum charts. I mean, even while we're still on this chart here, we've got a 3-leg part of the consolidation, and if you look at the momentum, the MACD, where's the line? So at the very top, when that failed momentum happened on Friday, we've since put in a new high with a lower momentum high. If you look at that, so that is what you tend to see in a range trading. Now we're down at the lows. We put in an ultimate low on the momentum just as we're hitting the trend channel. So that would suggest that you want to start thinking about buying here, but it might be that we need to line up with the support blocks and whatever other indicators you use. But you know, I look at Elliott Wave, which is by definition all about sentiment changes. When it looks particularly at when things are getting overdone, based on the whatever pattern we're in, whether it's a 3-wave or 5-wave, and internals to that. So it all depends on what you're using. You don't see how much money is being made, but pass rate. That's it. Mustafa, thank you. There will be another one out today. It's quite a bumper one, but what I looked at, PDF's not come back to be released yet, which is a shame, but it will be with you today. Farhan, November till now, gold has been on a major bull run, not to mention the gap at 1830s. Gold is going crazy. On a broad perspective, 2536 is not far on which golden analyst. So yeah, I mean, Citigroup, Goldman's, Deutsche Bank, loads of the mainstream guys have all been all over the idea of going to 3,000. Now, 3,000 is the inflation neutral level from the 1980s high. So when people say it hasn't kept up with inflation, that's what they're talking about. So around 3,000 to 3,200 would be an inflation inline print. So there's every chance we're going to get that. But I'll go straight into it in a minute. But there are a number of things going on in gold. And so forget the 15-minute and the 4-hour. Let's talk about the month-on-year basis. What in gold? Okay. Gold is definitely a manipulated asset, and that is something that I'm going to talk about. So remember last week we talked about, is $100,000 gold ridiculous? Well, it isn't if they are going to be told to revalue gold from the debt perspective. More and more credible people are coming on. I've been reading about this for years, and there's some good videos coming on. A lot of people predicted exactly what's happening now about a year ago. And remember, I don't know if you've been on the chats for the last few weeks, but the whole Bank of International Settlements, Basel III thing is totally opened the spigot for the catch-up in gold. And that's literally all based on the relationship between physical gold trading and paper gold trading. And I'll show you in a minute the stats on that, but it's quite ridiculous how much goes on. And the Fed are at the heart of all that because they need to try and keep the dollar looking credible while they're forever printing. So we're looking at the whole setup of gold from demand and supply side and the fiscal side, which is the printing of bonds, et cetera, and then we've got geopolitics thrown into a mix. Cyrox, 100%, they will have, to varying degrees, some information, but it's more the fact that you've got the dollar has devalued by 95% since they came off Bretton Woods in the 70s, and that's kind of out of control. I put it in last week's preview, the fact what we didn't really, no, it's in this, we talked about midweek, we didn't really factor in the fact that we got half the planet going into elections this year. So very few governments are actually going to put up tax rates or reduce their spending in the year that they're trying to get elected. So we're only going to see sort of equalization next year, but by then this gold thing will probably have left the station. Vivek, I've been trading for 7 years now. I've not seen such an environment where equities, commodities, and fixed income are all flying. Why is that a strange environment? You do get periods, they're very rare, where you have positive correlation between them all. Fixed income obviously has been a bit range bound. That's purely on where the inflation outlook is, and we've got an inverted curve in the States. So that is quite a difficult scenario. And normally, the longer that goes on, the more likely you are to get a recession of some sorts in the States. They've avoided it so far. Commodities, the demand for that is really driven from China in the main, which has been in a bit of doldrums, and we're just beginning to come out of that. So that's in a positive mode because their demand figures are off the floor, and they've changed their policy to one, rather than being building out houses and communities, they want it to be strictly industrial production policy, and to back massively their move to be the number one in renewables around the globe. So that there's a massive resource requirement to do that. So they're back on putting in demand for commodities, and obviously demand for oil is on the cusp of breaking out. The Saudis and OPEC are manipulating the supply on that and deliberately, artificially moving prices up, which is clouding the issue. What's happened there, and the problem for oil to break out much more than the 90s, and it hasn't held the 90s for more than a decade, is the fact that they've opened the door for US production. US have even run down some of their natural safety supply to fill in the gaps. They've been breaking into Brent markets all across Africa and Europe. And the Saudis and OPEC have left themselves open to having to come back on board at a time when the supply's already been filled in, which will obviously affect the price. So oil demand should, and that's why I said I didn't, even though I'd been looking to short it, that I changed my mind 2 weeks ago, is that some of the demand figures were coming through okay. India, in the meantime, has said they're pulling back slightly, and they're the number 3 demand in the world. But net, as long as China keeps pushing forward and Germany gets dragged along, then the industrial powerhouses should be at the forefront of that. And we're going to get part of the data this week is global PMIs for most countries in the world. So we'll see whether that manufacturing side is still on that story, on that narrative. Equities, again, the worry is, and we're going to go through that, is that it's all been driven by the tech, and there's been very little market breadth, but that might just be changing as some of the tech is giving up ground. But massive week, absolute massive week for risk assets. We've got Mag 7 reporting, Tesla tomorrow, which we can possibly ignore given how it's right on the base. But we've got Meta on Wednesday, and then we've got Alphabet and Microsoft on Thursday. Remember what I said, 3.8% for everybody in total for Q1 in the US, and 38% growth was supposed to be coming through for the Mag 7. So a lot. Now that we've pulled back to those wave 4 extremes, we can't really afford to drop the ball now, or we'll get double corrections. We'll have a look at that NASDAQ chart soon, and that filled in a lot of gaps from January. Where can you get where can you get the best sentiment on assets? So again, I'll show you the things that I look at as we go through the charts, but you want to be looking at where the stocks are trading, advance versus declines, and you want to see where stocks are trading versus their moving averages. Have your moving averages on the charts, but try and see which ones are trading above 50-day moving averages, 100-day moving averages. When that percentage moves, oscillator, MACDs, RSIs all give you extremes of sentiment. And it's not necessarily always looking at whether they break that 30-70 range or 20-80, whatever you prefer using. It's often the relationship between the peaks and troughs, which give you a clue as to what kind of wave situation you're in, whether the sentiment backs up being on a massive breakout wave, or whether it's showing you that it's an overdone and the end of an actual move. And then, there's tons of, there's so many different indicators. It all depends what works for you and what doesn't. So I wouldn't put you off that, using that one. Where were we? Did it. So everyone happy with gold from the charts perspective? we've had a good run, but I do think that we're in the right pullback zone. One of these supports for sure is going to see us go back into that trend channel. So again, like the dollar index we talked about last week, we've had this extension, double extension consolidation. Equal legs is a little bit higher, 106, 71, 70. Now it started putting in a bit of a retracement, but is that more of a triangular pattern before we put in a final high? There's every chance of that. And then remember, we've still got a chance for the month to be seasonally weak, but we're running out of time, aren't we? One more, please. Equities, so this is Vivek again. Equities net grew during the period of rate hikes. Now when the rate cuts will begin, equities go bonkers. Will that valuation be justified? I mean, the reason behind all that, we've said the rate cuts are, while ever we've got growth, the rate cuts are just like icing on the cake. As long as you're in an environment where they're not going up again, remember that's what hurt things a little bit last week. Too many people jumping on the fact not only would there be no cuts for the year, they might even have to put it up. Williams, who had gave no inkling at all that was his view, he's not interested in putting them up, just said if data happened to go the wrong way, then we would consider it. Totally taken out of context and used by the market to sell off. But remember the horse race, going about it, I deliberately did it that way. Growth trumps everything, sneaked into the lead, and that as long as growth is coming through, then we'll be fine. Remember, like the S&P, 28% growth since the lows in October, November. You know, you're bound to have a pullback, and generally, if that's a wave fall, that's going to be a 23 to 38% off a 28%. That's 5 to 10% pullback without getting scared. You know, that'd just be decent consolidation. Well, we put in most of that already. You know, you'd like to think that as long as earnings are okay and still pushing ahead, Q1 year on year isn't that difficult. You know, until we see the jobs market completely roll over and some of these guys not actually have any growth in their earnings, then the trend will probably resume back to the upside. That is traditionally what happens in the equities, unless there's a shock event. So I'm expecting a little bit of sideways trading in a very quiet week of data, really, until we get into the latter part. The Fed guys are not talking this week. Our favorite talking heads start doing the shapes. They've got their meeting next week on Tuesday into the 1st of May, which means that they're on radio silence. And then we've only got a few Europeans talking around the edges this week as well. The Bank of Japan comes into the conversation on Friday when they have their rate decision. It's probably too early to do anything, but they do have Tokyo CPI. It'd be lovely to see them get a high print there and be able to talk about the timings for another rate. Right, then we might start seeing the yen dig in a little bit. But really, most of that upside in UJ is being driven by you, isn't it? But we'll have a look at that chart again, because that, again, I think will roll over when the DXY rolls over. The issue we've got is for EU, really, because EU is digging in, but we know that they're going to have 3 to 4 rate cuts in the Europe when they start, and some of the hawks even were giving in last week. The super hawks in Central Europe were giving it July would work. Don't rule that out. But Nagel has said unless the data path changes, even he's okay with June, and he's the big Bundesbank German, sees inflation even when he's got his eyes closed. So for him to say there's a rate cut coming, believe it. So if they've got 3 or 4 coming and the US are going to do 2 or none, November and December into next year or not, then all you're going to hear is people talking about parity again, i.e. €1 equals $1. And at the moment, 106 is holding, and we've done a sort of retest. We may get the 3-wave retest of that. I still think there's a chance of us, if the dollar puts in one more high, we might get this pushed down to equal legs, 105, maybe 105.5. And then we should hopefully be off to races, and the dollar coming off a little bit, just to give us that. We want to get that Q2 top in before it gets difficult going into US elections and 2 nationalistic candidates who are more than likely going to spook the dollar. Why is there an additional weakness in GBP? Well, GBP, remember, who was it that was talking on Friday? Let's have a quick look at that. So Green has been super negative. She joined Haskell and Mann's again saying, oh, well, you've got to consider they might have to put rates up. But the talking head that mattered on Friday, where are we? Like I said, it's a bumper one this week. So lots happened last week. Friday, Ramsden saying on inflation, he thinks there is going to be a sharp downward print on the April CPI for the UK, moving us towards a 2% target. And then crucially says he doesn't then see it going back up again into the end of the year. So if that's the case, what's happened of late, the euro has looked like it's diverging on rate path and economies. For some reason, the UK has been thrown into the same boat as the US, and we've been tracking them. And the bond market, again, has gone down to there being only 2 rate cuts. Well, if we get a decent print for April or May in the UK and there is no further bounce back in inflation, then there's going to be 100 basis points off by the end of the year. That was what they always wanted to do. And it's an election year, and they won't hide their bias of going against that. They'd prefer the Conservatives in, or certainly forcing Labour to be sensible. So there'll be help from the MPC. There'll be a percentage off by the end of the year. Trader Prunes, good afternoon. I'm just doing Mondays and Fridays at the moment, but you can get me on my chat, etc. As time goes on, we may do different time frames, but we're just getting into the habit of these two for the moment. So today is a talk through my preview for the week, and then on Fridays we generally talk about what's gone on and whether anything's really moved. Yes, I do think so. Vivek, yes, the ECB will definitely cut rates before the Fed, and they will do it in June. So yeah, there is no. Please never apologise for asking questions. Ask as many as you want. That's the whole point of this. So the euro, yeah, definitely. There's going to be bias against it, and this is why, despite the fact it's set up for a big breakout, it might not be as strong as we first thought. It may end up looking like a sideways move up. But it's a two-edged sword, because you can have the rate cuts coming off, but if it's improving demand and improving economies, then you start to see funds flow into that region. So it tends to hold it up a little bit. I think a lot of people, Andrea Gallo, are having an issue with gold today. I did say this morning that stop loss it because it's in that triangle pattern, but could equally put in that test of the lower channel. We'll just jump back to it. So yeah, so on that chart, when we're chatting to people this morning, they were talking about this level, and then they're talking about that level. The 3-wave move we had down into that, what is labeled as the 4 low at the moment. So that could equally be an equal leg. So it's had a 3-leg move down to there, a 3-leg move up to the top of that triangulation. And we're putting in a 3-leg now. That again might put in another little 3-leg here and a bigger 3. It is definitely in some kind of diagonal triangulation, because most of the waves are in 3 shapes, 3 swings rather than 5 swings. So that's normally what you get when you have a consolidation pattern, particularly in a wave 4 idea. So this 4 will move to wherever this finally ends. It's either going to end on this support or do a double and come down and test this 2300. I'd love it to be here, 2320, just an overthrow of the channel line as it is at the minute, and then back up. And yeah, we have been consistently bouncing off fib levels and moving averages. It's almost like the automated systems are playing this perfectly, like a technical analysis exam. It's been an incredible move. The pullbacks have been so in line, it's ridiculous. So OJ, yeah, there is a potential for that, but it's not going to negate the upside. I still think this is within the time we'd have to start looking at a different pattern is when we do go down to 2300. We might have to consider that three wave as being a different kind of top. But there is scope for changing around in here, and ultimately the support down here 2280s and a fourth wave down here at 2250, the absolute extreme pullbacks. But in terms of short-term trading, then yeah, the bigger picture is definitely still in the ascension. It's just where we put in this relative low. It's a geopolitics unwind really at the moment. I don't think there's any negativity, but we're going to discuss gold and as to why you should keep the faith and try and find a way. Never mind buying Bitcoin, get hold of some physical gold if you can. So what's the analysis on UJ? So if you remember, we talked about this a number of times. 152 is that line in the sand from the intervention in 22. We challenged that, came off and had a January trend change, which we've had for the last couple of years and happened a lot in Forex at the minute. Then we're in the current situation. So we had all the continued, are they going to put rates up? Are they going to normalize? And it traded down into that decision. And then we bounced back up because they had no decent rhetoric to follow it. And then the dollar obviously dug in and has had pushback. So we talked about the fact once you have this kind of pattern, a barrier triangle, so higher lows into a massive resistance line, it eventually will break out. Then we had the big options volume at 155. So a combination of Powell the towel, no further rate hikes from Japan, just meant that we were going to break that. And we haven't gone through 155 yet. So it kind of feels like that's being used as an implicit line in the sand, but I'm not sure whether the Bank of Japan will actually pony up any money and defend it. They'll probably step out of the way. They're trying to talk it up, but not in any real proper way at the moment. They're hoping for help from America, but I don't think it's coming. In the meantime, there might just be a bit of hedging going on to keep this below what was a very big upside option play. Now, the way I'd got it set up is the fact this was an orthodox top the first time at the end of 23 when it failed at the 152 level. Since then, we put in a three-wave pullback, and then this thing looks like it's probably more of a first wave up there, a pullback into that anticipated low, and then we're putting in the third leg here. So that puts in a new high. That is possible if it's an expanded flat. You can get an overthrow. So I'm expecting there to be a pullback, which would actually put in a new low for UJ within this trend, back down to 140. So it's kind of suggesting that there may be some combination of events here. I'd love to see it come in from some advanced inflation from Japan, just so that they can get a surprise rate hike in. But it looks like consensus is later in the year for that to happen. And obviously at that point, the US may have started rolling over as well a little bit. Inflation wise, but it's it's a tough one because equal legs of this still takes you through that 157 kind of area. So I'm not totally in love with that as a sell of UJ. I want to see more evidence, but it just feels like we've been set up to do this just to catch the market out. I like that. I'm not going to look at Bitcoin at the moment just because we don't trade it. I'll deal with everything else first. FTSE, no one talks about it because the general apathy in UK investing for the last 3 or 4 years just winds me up. And there's been every excuse for people to buy into it. And when they talk about underinvestment in the UK, it's been put forward that the pension funds and institutions have got to declare their holdings because some of the incumbent UK people are actually underweight. It's a disgrace, absolute disgrace. Obviously, it's caught up. What looked like just a boring sideways moving FTSE has had a bit more impulse. It's looked like taking out the top. It never wants to hold above 8,000, does it? But we'll have another look at that later. Why didn't UJ get stronger after the Bank of Japan hike? Because Ueda is an academic, and he thought that just actually doing it would count. People were asking for a stronger guidance to when the next rate hike would be. So it wasn't just a case of normalizing policy. They wanted to know that there was actually going to be strength in the currency going forward. If you're investing abroad, you want that currency that you invest in to be stronger. So you'd expect the Japanese yen to trade up. So in this case, UJ go down. And that wasn't the case because he didn't back it. So if you're investing in Japan, you then have to hedge your currencies. That's expensive and takes away some of your returns. So you're trying to time it as an overseas investor, not only for the instrument to move, but for the currency as well. Then you get double whammy. So, but I don't know if you've been listening before. The good thing about Japan is that they're the most likely to see inflows because their earnings upgrades are bigger than anywhere else in the world at the moment. There's more of them. Their cycles have changed, and domestics are doing well. So the normalization of policy has helped their banking sector. So that gives people a reason to move into breadth, move sideways. Don't just have to buy the exporters, but those exporters are actually doing well because the yen continues to be weak. So it's a double whammy at the moment. It's difficult to lose in the Nikkei. I would play the Nikkei and have a stop loss at last week's lows if you're looking for equity indices investment. We will look at US 30 AR. So while you're all on, let's just jump back to I mean, Farhan, Japanese have got the best workforce and domestic economy is doing so well, and they're now getting pricing power back into it. So, and they've got the wages going up. People for the last 20 years have grown up not knowing about any kind of inflation or having increases in wages. So it's a whole new concept change, and that is helping convince the companies to tidy up their balance sheets and their cross holdings and do their ESG and their due diligence and behavior patterns to be strong. So it means people are confident in investing. So it's a win-win all round for Japan at the moment. So I just want to talk, before we go on to looking at a few more charts, I just want to talk through the whole gold idea, just get that out of the way because you'll see it in the pack. Boom, boom. So much happened last week. Teflon is here. Did you look at the Japanese flows on the CFTC? So on Friday nights, there might be a short about looking at CFTC. I'll just look at that before we do this. Hold on. Just give me a sec. So on most calendars, diaries that you'll find from whoever you use, I use investing.com. On a Friday night, there are always the commitment of commodities futures traders commitments where people are. And I was going to talk about one or two of these, but on the Japanese yen, we're looking for that turn, but it's just not happening, is it? So there's continued outflows. So buying dollars, selling yen, and they give you an aggregate that you can look at. Now the rate of pace of change is slowing down, which is half the reason why I think it might have a temporary turn. But in terms of flows against the yen, they're still very high. And that we were talking about where to look for some yen option exposures. Did you find any Teflon? Did you go on? I didn't have a chance to go on to CME and have a look. But that is a good indicator. If the futures flows are that way, that'll either be hedging flows or direct purchasing of dollars against the yen. The one that was interesting, and the fact that is this one. So the fact that the markets were really selling off look what happened last week in the S&P flows. So there's been kind of negative speculative flows against the S&P in general. That's why we've had no market breadth, but we've had a massive jump up on Friday, despite the fact that some of the tech guys were throwing off. And we'll have a look at the equal weight indices in a bit, and they started showing some rotation. So there's every chance that the indices may dig in here, despite one or two headline names going the wrong way. But what I want to do is, talk about that gold thing first. So last week we talked about what happens if the US decides to revalue gold to cover its national debt, and that could take you anywhere between gold at 20,000 to 100,000, depending on how much they want to write off. And you'll easily find lots of chatter from the Chinese and the Russians. A year ago, Russia said they wanted to set up their own exchange to get gold valued properly. And if you value gold in any of the currency, they've been performing quite well. What is not happening is a true physical gold price being reflected. And what is the main reason for that? Well, it's a thing called paper gold. So originally, derivatives were designed to try and create leverage that would be used by gold companies to explore, but that just got out and out of control. And you now have, if you look at 2020, anywhere between $200 and $300 trillion is traded in paper gold versus 11 trillion of actual gold trading. So that is, 20 to 30 times bigger. And within that 11 trillion of physical trade, only 10% of that has been central banks. So there's two ways of trading gold. You either buy it, store it, keep it secure, and actually have what they call an allocated holding, or you trade paper. So if you put your money in a bank, you then become a creditor of the bank. You no longer own that money directly, and you just hope that at some point they're going to give it back to you. But what happens is that gets lent out time and time again, the money multiplier effect. And that's how we get growth, and that's how the banks make their money. So think of gold paper trading as the same sort of thing. Gold gets lent to the market, but then gets lent out and lent out. But paper transactions take place all the time. So you think you're buying into gold, but you're not. You've literally just got a paper transaction. You're just a creditor of gold. So at any point, that transaction could get wiped out and you've got no claim. Some people try and trade with an option held within it to convert into gold, and they're kind of very clever people at the moment. But just working through these numbers becomes very apparent that the market is so geared to any changes in the physical trading. Now, remember, we mentioned last week within that story, Basel III that made the changes to the Bank of International Settlements have made gold a tier 1 asset, which means that if you want to hold it in your reserves as a reserve currency, so it's only gold and the dollars that qualify for this, you have to now own 85% physically of that gold matched against it. So whoever your bank is has to own that. In the past, they've got away with holding a proxy amount. So not only is physical gold not traded that much, but the situation is that I think only 1% of all transactions actually lead to a change in physical gold. Now, I'm just going to go through some numbers which will make you see just how crazy that is relative to how much gold is actually around, and why just a small change in that could see gold jump a few $1,000s. So we went through that. So you could easily have a run on any of these gold clearing houses or banks. 95% of London trades are in this unallocated form where no gold is allocated to it. And there's even the situation if you pledge your gold, you're not guaranteed to get back the same gold bars either. So it's an absolutely crazy situation, as Germany found out, which we'll talk about in a minute. So net, we've got this perfect storm of events, contested elections like we had in the States. That's just when your most stable economy is supposed to be safe, that puts a bid under the gold. Fiscal policy is out of control, as we discussed, and that seems to be a problem while there are elections going on. So you've just got this backdrop of ever more printing needing to be done, and then you keep getting the arguments with Senate and Congress passing the bills. The US weaponized the dollar. That changed the dynamic completely for the BRICS countries, Russia and China particularly. Moscow wants its own exchange. That's possibly going to happen soon. Now, as I just said, if you've got allocated gold, you need to have it, you need to own it, you need to have a claim on it. So you either leave it in Fort Knox. Do you trust the Americans? The most trusted are the Bank of England and Zurich. Bank of England has such a huge amount hidden away on behalf of other people. So one of the most trusted vaults in the world. China going into Taiwan, Middle East problems, as we know. The list just goes on. There's a geopolitical undercurrent. It's just asking you to want to trade in physical gold and onshore it, move it back to your own country. So the 85% ratio makes that come up. So you could easily see a situation where out of these hundreds of trillions of dollars of contracts, a lot of them fail because people ask to deliver gold, but the gold can't be delivered. If that happens, then the paper gold price gets hit, but the physical gold price goes up through the roof. And it's all a case of how those two connect. What you want to try and get is a situation where we'll see the paper price of gold will ramp up before it interchanges with the movement in the physical. And if you can get hold of gold, you're going to make out like a bandit. So someone mentioned manipulation. And yes, it definitely is one of the most manipulated things on the planet. JP Morgan got caught out a few years back for doing open trades. Whenever the exchanges are asked to tell you what their settlements are, there's always an underreporting. So it's very difficult to see where the bias is on the buying and selling of the physical gold. And we touched on it earlier. Why does the Fed want to manipulate gold? Well, their inflation really, well, their purchasing power is devalued so much that they don't want to let that escape. It would normally escape by gold going through the roof and equalizing the pricing. So what needs to happen is there needs to be remember, gold is a currency against the dollar. So it needs to be sellers of gold and buyers of the dollar to actually keep the price suppressed. So what Americans do, they print money and they put in paper contracts to sell gold. And then what they do in order to not get hurt is they buy back contracts called calendar spreads. So rather than they'll sell April and they'll be buying back June. So it tends to keep the thing under control until people work out what they're doing. But they use so many different people and ways of doing it. It's often difficult to know who is actually doing what. But all we know is that it's been suppressed for a long time. So as I said, only 1% of paper gold contracts ever call for physical to move. So completely dwarfing the main market. The real price should be reflected in the physical. So 2023, gold traded $162 billion a day. That is equivalent of 29.7 billion ounces on the year. The total amount of gold that has ever been mined that's above ground is 6.8 billion ounces. That's 4.5 times traded on a yearly basis than what exists. There is another 59,000 tons under the ground in proven reserves, but that costs money to get out and to actually find completely, etc. And at the moment, there's a struggle to find financing. So it's only going to keep the supply tighter. This is the super cycle that I've talked about. 2/3 of that gold has been found since 1950. Now just look at what happened last year. 3,644 tons were mined. That is 116 million ounces. And yet we've got a deficit of, what have we got? 23 billion ounces on the trading basis. So 4.5 times the gold above ground ever produced trades on a daily basis. And 20% of what is mined is ever available for investment purposes. So only 20% of that 6.8 billion. So 1.2. So you're back to a factor of around 30 times exposure to paper over physical. And again, we know that central banks are only holding 20% in the actual reserve. So it could be another factor of 5 above that. So it's absolutely crazy. So you'd only need, let's just say, if supply is only going up 1 or 2% a year, and that's 116 million ounces, this thing could just pop like no tomorrow. So 1% extra of physical demand from that paper contracts would be 300 million, 1/10, 1/100th of 29.7 billion, with 300 million ounces. That is 2.5 times the annual mining amount. No wonder there's an absolute squeeze on in gold if there's a reason that you need physical. Well, hello, there's how many geopolitical and regulatory reasons do you need that this whole equation is changing. That is why we are seeing dips bought like you can't believe. So rather than the invisible hand on the market, I'm saying you've now got a visible tiller on it, hand on the tiller. And just to compound that whole mix of Americans and the Fed being one of the big shorters, never quite know where they are. There's this thing about hypothecation. So if a central bank holds gold, then they can lend it out on the basis they need to get it back. And that, again, at times of distress when people want their gold, you've got to go and find it. So that's probably putting another bid on the market. That there's the rumor that America is short 10 to 20% of the supposed 8,000 tons that they own. Why do we know that that's likely to be? Well, they've never answered a request for a full audit of what they own in what they hold in Fort Knox. Why wouldn't you do that if you're the reserve currency of the world and you're supposed to be the most transparent? Germany 10 years ago asked for their gold back. They've been going on about how they've got 200 billion of it. And America invited them over and said, look, we can show you which vault it's in, but we can't show you where it is. We don't know. They literally couldn't find Germany's gold. Did they not have it? Had they lent it out? Had they done something with it? And they tried to send them weaker, lower quality grade, 22 carat rather than the 24 carat, bumping it up. So what should have taken 3 weeks at 12, 12 tons a day you can fly. So it should have been 15 tons a day it was, I think. To get 200 tons over would have been 15 days. And they couldn't do it. It took them 2 years. Tells you everything you need to know, doesn't it? There are lots of problems in this paper fiat gold world, and it won't take a lot. So even at a conservative basis, if we said 2.5 times the yearly amount of gold produced feeds through to the current price, that is going to take you to at least $5,000. Many people who've done the maths looking at what if you were to have a 15% share of a new currency based in gold, that would put you anywhere between 5,000 and 16,000. And we've done the maths ourselves, talking about the extremes for American debt write-off would be anything up to $100,000. Where do you think gold's going? It's certainly not falling back down to 1,800 in any hurry, is it? So hope you found that useful, and it is in the preview, blah, blah, blah. I did run over the yen Rayhan. I don't really want to go back to that. This is recorded. You can play it back, and there's the chart within the pack. I do feel like we're due a counter trend rally, even if it's part of a consolidation. Blah, blah. So the Oxford English has closed their long positions on gold, and there might be rate cuts from the Fed. This means we might expect gold to at least test 2,200. What do you mean by that, Teflon? The Oxford English has closed their long positions on gold. If you get rate cuts from the Fed, then real rates will change, and that will send gold flying again. It's almost like everything is lined up to help gold. It's difficult to find a bear case other than if rates was to go up in the States and you got a run the other way. But if that's happening, it's because you got inflation. Gold, as we are attesting to, should be an inflation hedge. It's been artificially held back. We've now got it running. People, all the sensible strategists are talking for it to be in line with inflation at 3,000. So, who are you going to trust? So, yeah, I think medium term, short term, medium term, long term, you want to be holding gold. There's obviously going to be some shorter time frame trading ranges that take it to extreme. By definition, at the prices we're at, 4 and 5% moves are now, the best part of $100. So we need to invest and stop loss this properly. Just be careful. I'm trying to knock it out of the park. You can just see the innocent moves you've had today have hurt people quite a lot. So let's run through a few of the, unless there's any other questions on gold, we'll run through some of the charts. Everyone okay to move on? Yeah. Please leave me some comments if you can on YouTube, and I will work my way through them this week. Any advice for things you'd like to see, things you like, any general questions? And I'm seeing Alex tomorrow, and I'll pin him against the wall to get some kind of special discount for people that can prove that they're on this chat and stay on it for more than 15 minutes. No questions. Cool. What Teflon Molly there? What were you saying about the Oxford English? What does that mean? Martin Curry, thank you. Yeah, I mean, yeah, I like to delve into details on all of this stuff. So believe me, I've done a lot of reading and watching and cut out a lot of the crap that is in there. But this is a seriously fundamental move. And all you've got most of the mainstream media talking about is geopolitics and inflation cycles and how gold isn't an inflation hedge and it isn't this and it isn't that. That's because it hasn't been allowed to, and central banks had, for whatever reason, a reason to take their holdings down post Bretton Woods, but the whole situation is reversed. Nobody expected successive Fed to get away with the debasing of its own currency. So de-dollarization, as much as it used to sound radical, is now going to have to come to a head at some point. Am I in the Alpha Capital Group Discord? You bet I am. There's Planty's Market Watch. Where are you? Yeah, bang everything in there. Put it on my chat. You'll find me. Goat Ed. Thank you, Goat Ed. Yes, Vivek, thank you. Keep coming back. I'm fighting to get us some freebies. That will come on, because we've only just started doing this. That will become a regular feature. Right, so can you see this chart here? Let's have a look. So just things to be aware. It was all absolutely end of the world for indices, wasn't it, last week? But under the hood, I said the S&P CFTC data said that there'd been inflows, despite so the market's coming off, but there were speculative inflows into it. 3 weeks of absolute dire performance. But if we take that down to daily, it starts to get interesting. Look at that. From midweek, this thing started flattening out. And on Friday, we even had, as you saw, we may not have seen if you don't look at the equal weight, but the equal weight started moving up. That's telling you that there's rotation going on, even though we've got some of the big techs rolling. We've got money coming in and we've got equal weights moving up. That is rotation. That is market breadth. The one thing they said that we hadn't got. So it's a really good sign that things might not be as bad under the hood as we thought. Obviously scary to look at the NASDAQ because, I was looking for that 1 to 1.68. That's had a proper move down. These kind of candles don't show it you as well, but you can take it when they secularly move. Often they're gapping up. Well, look, they took out every upside gap all the way back into the start of this year. This becomes a very important stop. 16,200, which is where are we today? So another 5 or 6% downside, and then there'll be proper panic on. But I think this has still got the hallmarks of being a three wave down. We should have at least a 3-wave consolidation here, even if it's just a connector before we sell off again. Now, I think this week, as we said, is big on earnings in the tech space, and we've got what I said. We've got Tesla. Ignore that one, really. We've got Meta, Alphabet, and Microsoft. They could easily change a narrative here, alongside the fact we've got flows going into the other sectors. It wouldn't take a lot just to make us even go into an up and down, what is quite volatile, flat, to still be not putting in a new all-time high and staying flat. Could even have an overthrow, expanded flat, and be a valid consolidation before we pick up again later in the year. But it might, this might just be putting in the extent of the negativity, which we then trade sideways against for the next few months. Big week. This could obviously turn the whole thing on its head with a return to outperformance earnings. And we've got a lot. It's not just the Mag 7 guys. There's a lot of heavyweight S&P stocks updating this week. But quite scary breakdowns. We're all trading. It talks about psychology, and you walk into these things. I mean, Imagine you're still long Nvidia. Nvidia has gone down in a straight line almost, hasn't it? It's right on a 38.2 fib. So that could definitely have done, a first 3 waves before it has a bounce, even if it's going to come off. They don't report for a couple of weeks, so they could be dragged up by good earnings again this week and then still have a slight miss further down the line if we stay in that. And then hidden within that, I don't know whether you follow this stock, but it was one of the headline ones, wasn't it? Supermicro Computer. I mean, that actually started falling in from March the 8th, way before some of the indices put their highs in. And that's put an equal legs 3 wave in. But, they said they weren't reporting on Friday. Got hit 23%. I mean, it's just absolute nightmare, isn't it? So some of the darlings have both put in very quick moves straight down to important fib levels. Are we going to bounce off those? And then hidden within TSMC and ASML, that was some very technical sell-offs. It was a whole outlook for semiconductors on the auto side and on the iPhone side. It's not helping with iPhone sales numbers being beaten up in China. That's happened for 2 months in a row now. So there's a panic on. It's probably overdone. And again, this is sat right on a classic fib pullback for the SOX in a 3-wave swing. You'd like to think there's at least a relief rally coming, but you're a trader looking at that. It's scary, isn't it? You're getting stop loss time and again, trying to catch the knife. So the Dow, it's all about, is there enough of this final move down into overnight with the Israeli situation? Did that put the 5th wave in of the C wave of the WXY consolidation? We bounced off it and we're holding. I think it's interesting to look at the Dow in the weekly form, in the daily form, sorry, because that, again, it was the first index that started rolling over while the others were holding up. The Dow Transport leading it down, etc., etc. But that has put in, on a closing basis, an equal legs 3-wave pullback. We had that overthrow on Friday. Does that count? If that is a valid 5 waves, then we're going to get a 3-wave up and another move down. But that could equally be an A, B, and a final. You could count 5 waves in this C leg, which makes it a valid 3-wave consolidation off 1 for 1. And the Dow might lead us up. Financials index has dug in. What they call the value plays. That's what's attracting a lot of the breadth money. The long bond hasn't blown up despite the fact we're only looking at 2 rate cuts. We've got kind of solid growth, not runaway growth in the States. It's not going to take a lot to make that pattern turn around. The advanced decline lines have nearly flattened again. Momentum's on a turn. Is it going to get a fake hook and fall down? Don't rule it out, but we are coming off sells, 3-wave sells into fib levels and into low momentum lows. We should get a bounce off that, like I say, even if it then turns down. Mention the euro dollar, mention the yen. So we've got the same situation with the Nikkei. I said again, that looks like we've got a pretty distinct 5-leg move down here to complete. We've so far rallied and not returned anywhere near it. So let's hope that we're doing a nest for breakout. But I'm advising you to have Friday's low as the stop loss if you're playing the Nikkei, because again, we might just be putting a connector in for further lows. I don't think so. I think this is set up to be the area to stay, but it has had one hell of a rally, hasn't it? Good ARM gain, half the current value of Nvidia. I mean, Nvidia, the classic thing, isn't it, with all these things that lead the moves up? Do they end up being the winner going forward? I think, they're obviously a first mover and they've got contracts coming out of their every orifice, as they say, but you'd expect the sector to catch up with them. And it's all about who has the next iterative stage, which is better and more trustable. So you can't rule it out. It literally is an arms race, isn't it? So you'd expect ARM to be in there. But That was a question from OJ. Sorry. The only other one is it's a classic, don't beat yourself up when you have the right, you had the right play in place. Remember, I talked myself out of shorting oil. I moved it from 83 to 86, looked for shorts. Then the whole demand picture changed. The Chinese started putting in demand upticks, geopolitics through the roof, and yet we couldn't put in a new high, couldn't get into 90s. And we've put in a 3-wave, of which the current downward bit is aiming for 79. Now already the wick on that candle has put it into the wave 1. That's called overlap. And if you get that in the stage that we're in, which is supposed to be a breakout wave, that could be a leading diagonal. I might have to recalibrate how that is, because if that's a full wave 5, if that's a wave 3 movement, you wouldn't really have a leading diagonal in there. So I have to have another look at that. That's suggesting, which is why we have to have alternative views, that might have to look at the whole situation here. This has been so protracted sideways without any real full impulse in it that it might be an extended second. So this could all be an extended second wave. So yeah, that by definition, I need to go and have a relook at that. My point being, don't beat yourself up when your analysis is right, that it's dropped back $6, but it still pretty much looks like it's got one more impulse left in it. The fundamentals are right. The technicals are probably going to catch up. It's just the nature of whether the actual wave pattern is correctly labeled at the minute. We go again. We just set up. We're looking at the moment. I'm looking for a reason to buy this for a breakout. Obviously, if gold's coming back, silver is in a similar situation. Now, another thing to remember about silver, as we were talking about fundamentals, is I don't think a lot of people know, but I think it's 15 pounds or 15 kilograms of silver goes into every Tomahawk missile. And there's a bigger relative shortage of silver than gold, even, I think, when you go through the industrial demand. So it's another one that will have a catch up. Normally is the gold moves and then silver catches it up. And don't forget, silver has been used in the mix of gold standards, monetary asset, fixed asset standards over the years. So that equally could become a factor part going forward. Silver, I've been looking at that and wanting that to pull back, just like we're wanting gold to pull back. I wouldn't put you off buying it into the right dips. 500 ounces, is it? I know it's something crazy. So don't rule that, we're talking about reloading, aren't we? We're reloading Israel, reloading Ukraine, and there's a $10 trillion campaign coming from NATO to rearm the whole of Europe and the US. Which way is silver demand going? It's not difficult, is it? So we're an age where certain factors that have been rumored are all coming home to roost at once, which starts to give you confidence of buying the lower trend lines on if you're a swing trader, and obviously looking for extremes when you're a short-term trader. Just knowing what's in the background, knowing that when they're on the bottom of the trend lines, do you really want to be taking on that all in bet to downside? You might get lucky, but the trend is against you, isn't it? So are there any other questions? Have I taken us through everything that's happening this week? I'll just jump through the data. Did we talk about that? So it's a quiet start. Tonight we've got Aussie PMIs at 12 o'clock. So it's kind of in a right move. HPI jumped back up. I've said there's PMIs everywhere. So you've got Japanese, UK, Eurozone, France and Germany tomorrow. Public sector net borrowing, that tells you the state of the finances of the UK Treasury. US, they've got their PMI and home sales in the afternoon. Aussie dollars, CPI. The German IFO, that's the one I do like to look at rather than the ZEW, and that'll tell us where the true demand is. US durable goods, we know what we're looking for. Repeat after me. The Air Jordans, no defense, Air Jordans. Oil inventories, they've backed up for a couple of weeks. That's hurt the oil chart. I forgot to say that there. We need that to go back to normalization. That would probably be the start of the rally. Aussie and New Zealand are on holiday on Thursday. Haven't checked whether that means their markets are closed, but it might be. Japanese leading index. Then we've got US GDP and its deflator. That might be helpful on Thursday going into the actual PCE, which comes on Friday. UK consumer confidence. Wages are holding up. That should be okay. House prices dipped last month, so that might feed through. So that might be a bit of a mixed print there. But generally, it's more full-time jobs in the UK as opposed to the States where it's part-time. Eurozone money supply, we'll keep an eye on that. That could really help any kind of drop in that, and they're definitely going in June. Like I said, Japanese CPI and Tokyo CPI, hopefully they know what they are before they do their meeting. We'll get the press conference at 7:30 on Friday morning, just before the London session, see what they've got to say. Aussie's input prices come out overnight as well. You've also got spending and income in the States. And then Michigan, one to ignore really this month because we had that jump last 2 weeks ago. It's a bi-weekly survey, nothing but pushback has happened since then. So there's not going to be much helpfulness on the expectations there. Like I said, very few speakers and nothing from the Fed. It's around the periphery of Europe. Europe again threw everybody out. Just about everyone on the board had a chat last week. Within the pack, I put in the picture somewhere of who everybody is. Yeah, and when we talk about who was speaking last week, I put in a chart there that was done on Bloomberg Economics of the hawks and doves of the ECB, pictures and where they are. It's a useful one to have in the background. Keep a copy of that. But I think that does it. I've got something coming up at 3, so I need to shoot. As always, any questions on YouTube or directly into me on the Market Watch with Planty. Good luck with your trading. It's tricky, isn't it? Take care.